I'm joined today by Alan Pullen, Portfolio Manager at Magellan Investment Partners. I'd previously heard Alan say on a podcast that if you're not a naturally curious person, you're not going to make for a very good analyst. So for this chat, I wanted to discover what businesses Alan was ultra curious about right now. Alan dives into Google or Alphabet and its battle for search, Nike and its recovery, and music label Universal Music Group. On top of this, we scratch below the surface on how Alan and the Magellan team operate. This episode is presented to you in conjunction with the Australian Shareholders Association. Alan, mate, let's start off. Can you tell me what a day in the life of Alan Pullen at Magellan actually looks like?
Yeah, of course. I'm not a particularly early riser. I'm not one of these, superstar CEOs who likes to get up at 3 a.m. and do a 2-hour session before coming into work. So I typically get up around 6:30 or so. My girls are getting older now, but I still, do a lunch for them often for school, at least for the youngest one.
How old are the kids?
Well, the youngest is 16. She should be doing her own. I know that, but so just to help going to year 11, de-stress a little bit. Then head into the office. Typically, the workday starts with the papers for me. So, you've got to have a really broad range of understanding of what's going on around the world when you're looking at global equities. And so I typically read kind of at least the Financial Times and the Wall Street Journal, and sometimes touch on other papers as well to kind of have that broad range of coverage of what's happening in the world. Then we go into our morning meeting, typically, which is 9 o'clock. We have all the analysts in the room.
How many analysts is that?
So we've got about 16 on the global equities side when we count everybody up, the PMs, the analysts, the whole type of team. So we'll go around and basically talk about anything interesting that's happened. Obviously, during results season, that can be quite a long meeting as you're going through the results and the new information that's been coming up from the companies, the investment implications and what that means for kind of our long-term investment thesis, or any other kind of relevant news that's going on around the world. It could be regulatory, it could be macroeconomic, it could be geopolitics. So that kind of wraps up the morning for us.
I'm curious as to how you structure that team of like 16 analysts, because you're a portfolio manager across multiple funds for global equities. Those 16 analysts, do they operate across all those funds? Are they fund specific or sector specific in what they look for?
So they operate across all funds, as in we have one core investment philosophy. And really the separate funds are more to do with the risk appetites of investors. So, I'm sure we'll talk about the core investment philosophy and the importance of that, but, we're looking for a common type of stock and investment view, but we do have, the global fund, which has a big element of downside protection to it. So that will have more defensive element to it. The Global Opportunities Fund, that's more geared to relative returns relative to the market. But the same underlying investment philosophy, the same stocks, the same coverage, the same analysts kind of feed into those two funds together. And they do have sector specifics. So, we do want to dive deep into our stocks. We do understand, the industries, the companies really, really well. And we think that's best achieved by, an analyst spending, a good amount of time getting to know a specific sector before perhaps branching out, into other sectors. We have, franchises team, tech, communications and media, financials, infrastructure, of course, as well as healthcare.
Excellent. So, are there any sectors that aren't covered by an analyst?
We're not looking to cover the whole world. So, what we care about is really high quality stocks, stocks that we expect are going to compound value over the long term. Not just, have a good quarter, but, have a good 3 years, 5 years, a great decade. And we find that, that particularly suits certain sectors more than others. In particular, we find those companies with high quality in those sectors that I mentioned. That's why we target those. Whereas you think about things like energy. Think about commodities. Those companies tend to be more cyclical. Depends on what's happening in those energy markets, commodity markets. The oil price has been, negative and over $100, I think, over the past 5 years. So how do you determine with confidence where the profit pools are going for those companies kind of over that period? So it goes towards both those long-term economic moats, competitive advantages, where we find those, but also, as I mentioned, the global fund, we do want to reduce risk in that fund quite significantly. And so those more cyclical sectors just don't suit that low risk appetite.
So I'm going to ask a deliberately vague and wide open question. Alan, to you, what makes a good investment?
Look, it's a good question because, it's different for different people and it's different for different organizations. But, what I came to Magellan for is because what Magellan looks for is exactly how I had come to think about investing over time. And always, I've been a little bit of a natural contrarian, sort of had an inclination that value is always important, intrinsic value. And I did learn early in my career that I was covering banks in Asia, for example, and that if you buy the cheapest bank, you're often buying the worst bank. And you'd come to a downturn, and it would just be a terrible, terrible investment because the big, strong banks would thrive and the weaker banks obviously would come into question or go out of business. And so I came to understand that, yes, intrinsic value is important, but you have to do so within a high-quality universe, within high-quality companies. And it's that combination of quality and intrinsic value that actually deliver your best returns over time and your safest returns over time. So it's exactly what attracted me to Magellan, because that's exactly what we try and aim for, those really super high-quality companies, but at an attractive intrinsic valuation. And I do want to make a quick comment here. Like, people talk about value and they think it means low PE, and that's what it's come to mean in markets to a degree. But low PE stocks can be expensive if they're crappy companies, right? Intrinsic value is a very different concept. It doesn't have much to do with PE. It's to do with analyzing the fair value that you should pay for a company. And that might be 10 times earnings, right? But it might be 30 times earnings. Like, if that's an outstanding company with amazing prospects. If you'd bought Amazon at 30 times earnings, over the last 20 years, you would have done amazingly well, right? It was undervalued at that price. So it's about understanding the price that you should pay given the quality.
Are there any quick guides that the individual investor out there could use, some quick rules of thumb or things to look at to assess that?
Look, it is tough because it's idiosyncratic for each company, and it changes over time. Look, if you really want a rough guide, you can look at the company's history of where it trades, particularly relative to the market. The good company, the market gets it wrong all the time, but on average, the market tends to get it right. So, if you look at a long enough history for a fairly stable company, this is hard with a newer company or a company where industry is changing quite rapidly. But if you look at the history of a fairly stable company and see, well, that company typically does trade at about a 20% premium to the market, that can be a kind of an indicative shortcut. What we do, obviously, because we have the analysts and the deep knowledge, is do a much more thorough and in-depth analysis of the industry, the sector, the prospects, the potential disruptive threats coming to those companies to have a more nuanced view. But if you are looking for a shortcut, the market's wrong all the time, but on average, it gets it right. So, you can look at those history.
That's really cool. I want to see, what does it look like when one of your 16 analysts is out there and bringing an idea into this meeting that they've done the work on, they're pitching it for one of the portfolios for its suitability.
Mm-hmm.
Just to give the individual investor out there an idea of the kind of work that they put into this, like how it's a brand new idea, how much time on average have they spent, how much have they done a lot of traveling, like what kind of effort goes into a Magellan portfolio stock?
So a lot. So, there's 1,600 stocks in our index or so kind of around the world because we do invest in larger cap companies. But in terms of what we think makes the cut, it's only a little over 200 in terms of what is a high quality company to Magellan. And, we've got some very specific factors that we look for and we make an assessment on. And it's the analyst's job to basically put together a report. And this can be, months of work. I've seen some take 6 months, 7 months. If you're go to woe and not working on anything else, you can do it quicker than that. But, it is a significant time period of work. It's mostly analysis. It's mostly digging. It's mostly understanding the industry, understanding the company. We'll talk to experts in the field. We'll become experts in the field effectively of whatever that company is involved in. And there might be some travel involved, although these days, of course, we can talk to the company on over the internet as well as we're doing today. So it's a very in-depth process, though. And in terms of that report, it doesn't include valuation at this point. To get on that list, this isn't about, is it, an attractively valued company? This is purely about, is this a high quality company? And they come with a recommendation on economic moat, which is the competitive advantages that company has. How large are they? What are they? Is it network effects? Is it scale? Is it brand? What is it that makes this company actually special? How long? What's the duration of that? What are the disruptive threats to that competitive advantage? So they'll make an assessment on that, as well as business risk, agency risk, which is the risk that those cash flows that the company generates, come to you as an investor or are squandered by management on empire building or perhaps taken by governments around the world, and a reinvestment potential, which is the other super important category. Does this company have a nice tailwind behind them that when combined with an economic moat means they can really grow that profit pool sustainably over the long term? They're your long-term compounders. They are your best stocks that you just hold year in, year out, and deliver outsized returns when you look back over 3, 5, and 10 years. So the analyst brings those to the investment committee, which is made up of senior members, and we will have an in-depth, thorough discussion on what the appropriate ratings are for each of those kind of categories. And indeed, whether it makes the cut to be in the investment universe.
I could imagine it might be a little bit stressful for the analyst if they've done months and months of work and then they're presenting it to the investment committee and, things, as you probably know, you can do a wonderful analysis and the investment still doesn't go your way as well. And so you've got to kind of separate the process from the outcome. How do you assess them on that, I guess, that return on time in that process?
Yeah, no, it's a good question. It is a big in-depth process and, we try to, and that's the official end of it, but it's not like the analyst will go off on their own, do 6 months of work. We've got no idea what they're doing. They're just working on something and then they turn up and here's the report, here's this company. So, we all sit together, on the floor. We're constantly discussing ideas. We'll be familiar with the stock and the concept. We'll have had some back and forth. There'll have been a preview meeting where we'll go through kind of the basic.
I'm imagining the MasterChef judges, walking around the benches during the cook with their little spoon having a taste.
Yeah, it's not a bad way to do it. We just what have you found here? Okay, that sounds interesting. Let's explore this part of that company. Have you considered this risk? So hopefully it's somewhat stressful. You're going against you're presenting to the senior members of the team and all that. And you want to defend your recommendations. But, there's been plenty of interaction through the process that, we rarely would have a company kind of fail at that last hurdle. Hopefully it's been screened out earlier. It's more about calibrating, those recommendations. So I think it's absolutely fine to go in. An analyst recommends a a medium kind of moat. And, the investment committee will actually opine and say, actually, this is more like a low moat business. Look, that happens all the time. And that's the committee's job. But rarely would there be one where, no, this is just definitely not in our universe.
I'm curious then as well, and you do or don't have to answer this, completely up to you, about the incentives kind of structure around the portfolio management team, the analyst team, because they work. I was going to ask, are the analysts actually invested directly in the portfolios that they work on? But because they work across several portfolios, and they probably have a good idea what portfolio their stock's going to go in. They might not have a direct exposure to the performance of that stock if they're not invested in that particular fund. So where's that skin in the game come into it for yourself and the analyst team?
Yeah, look, so it is different. I mean, I think for the portfolio manager and the portfolio management team, it's very direct, right? It's, you are responsible for what you promise to deliver to clients. And I take that responsibility, pretty seriously. I'm never going to blame, an analyst or anybody else. If I have a stock in that portfolio, it is because, yes, the analyst has recommended it and done the work, but it is because I have been comfortable with that. I believe in investment case, and that at the end of the day, if it doesn't deliver, I will take the hit for that and explain what went wrong with that investment case. In terms of remuneration, yes, I'm invested in the funds. I'm invested. My friends are invested. My mum's invested. So I believe in what we're doing. So I do believe in eating your own cooking, and also, of course, in terms of the bonuses each year or whatever, they're obviously linked to the performance of those funds to a degree as well. So there's definitely a lot of alignment. The analysts, less directly, of course, they can't control what a fund does. They will have input, but a lot can happen. So they're more aligned versus the overall success of the firm, and how the firm is doing, how the global equity strategies are doing.
Right, excellent. So, and also then through potentially employee share schemes and things like that,
yes.
that are in place. We've spoken a lot now about some behind the scenes stuff, which is fantastic. Let's get into some companies now, Alan. I've listened to Magellan's actually got its own podcast, and I've listened to you on that podcast a few times. And I heard you once say on a podcast that what makes a good analyst or investor, and here's your quote, "You've got to have an intellectual curiosity. If you're just doing this as a job, you're not going to be doing it very well." So I want to dive into a couple of companies. I've written here 3 companies, but look, if you want to give us 4, if you want to give 2, it's okay. But I want to see 3 companies that represent your absolute peak levels of curiosity.
Look, it changes over time. So, I would say whatever I'm focused on, I become intensely curious about. And a couple of years ago, that might have been the chip manufacturing process, and diving deep into TSML and just the amazing kind of work they do producing these high-end chips, or ASML. ASML, in terms of the lithography equipment. So it really depends. Historically, banks are boring, but fascinating when you think about how important they are, for the economy. Think about the GFC and what was going on there. So I could talk about a lot, but I'll go to today and what I'm thinking about at the moment to keep things a bit more live. So yes, the underlying premise there is, if you're just doing the 9 to 5, tick off the basic blocks and say, look, that's good enough. That's not going to cut it, where you've got thousands and thousands of really good investors kind of analyzing these companies. You've got to be passionate about it. You've got to be really interested in gaining an edge effectively. And that edge is, yes, knowledge is important, but it's thinking investments. What is the long-term investment for this company? That's what most people aren't doing. So you've got to go above and beyond, I think, to be really, really good. Probably at a lot of careers, but I'm sure if you're a professional tennis player, you need to kind of, not phone it in, right, to be really good. So it's a similar type of thing. So what am I interested in right now? Well, I think Alphabet's interesting. I mean, a lot of people are talking about Gen AI, and I don't want to focus on that too much because I think it gets a lot of airplay at the moment. But what's really interesting about Alphabet, who own Google, of course, is that they're playing on both sides of this. There's both an opportunity and a disruption risk. So that's really quite fascinating. There's some clear winners. There's some clear things under threats. They kind of sit in the middle. So it's really fascinating to get dived in. What are their opportunities? As search evolves into kind of Gen AI search, can they be, as profitable as that? And they are in historic search. There will be other players. OpenAI will be a player kind of in this potential new wave of search and Perplexity and other companies. So what are their opportunities there as search evolves? Are they going to be able to shift people across from their legacy search? Should we be calling it that yet? Or existing search?
I mean, I was doing some searching just before, and I don't think I scrolled past the second response, because one thing I've noticed is that AI response at the top is getting better and better.
Yeah, absolutely. So there'll be a real player there. But, that existing business, that legacy search is incredible business. It's basically a global tax on commerce. You've just got to pay them if you want to be, in commerce. So incredible business. It is made, it still accounts for the bulk of their profitability today. So that's the threat, as we move from that legacy search to new search, which is where they're also very well placed. And then you've got to think about, well, what else? Alphabet's got YouTube. YouTube is a great business. They have more viewing membership, more viewing minutes in the US than Netflix. So that's an incredible business as well, Netflix. So, that's a great business, will continue to grow. Google Cloud Platform is a key beneficiary of not just a shift into the cloud, but Gen AI as well. So they're another winner on that side as well. And, Waymo, right? We've talked about driverless cars for years now, but they're finally being rolled out. And Waymo, owned by Alphabet, is the leading player there. So that's another exciting part to that business. So it's really fascinating at the moment. You've got these really strong, growing, high-quality components, but one very profitable component that's actually under a significant amount of threat. So, an area we're spending a lot of time working on.
So you're really diving deep into those threats of Alphabet at the moment, because it does seem like of the Mag 7, there are a few, of course, that are charging ahead and looking like key real beneficiaries from this. But Google itself does seem like something that could be, that search could be yesterday's hero, so to speak. So what type of work are you doing around that to get comfortable with that investment case?
So first of all, we're diving into where we can see what the alternatives are, where the data is, where are people going for their search. But a lot of it's about thinking about where this evolves going forward, and then thinking about the offsets as well. So we've been doing, a lot more work around, what's the profitability likely to be in new search, right? Is it going to be, what's the business model? Is it advertising? Is it subscription? So it's more building these probability trees of where this might go and how Alphabet, Google will be placed under some of those scenarios. And more thinking about the range of outcomes, and then a lot of work on, well, what are you actually paying for this then? What is Google Cloud Platform worth? It's worth a lot of money. So, what is Waymo worth? It doesn't make any revenue. We think it could be worth $200 billion, right? So, what is YouTube worth? Quite a lot. So, how much are you actually paying for this search business? And if it would already being priced for disruption, that's fine. But if you're still being priced for strong growth in legacy search when you've got these other threats coming at you, that's less attractive. So it's a lot of work around the different components, probability trees of where it might go, and what you're paying, and what is a fair price given that range of outcomes. And we've actually moderated the position size a little bit, just given it's a more two-sided potential outcome here on Gen AI, as opposed to, Microsoft probably you'd put clearly in the winner's basket, right?
So you have actively de-weighted the Alphabet in the portfolios to say, hey guys, we are doing some more work on this. Let's keep it hasn't exited completely, but you want to continue to hold it whilst you do some more work on it, but at a reduced weight. And then when you get more confidence on it, or say that valuation improves even further, well, then it would potentially increase in weight.
Yeah. So how I think about position sizing is, we've got what I said we were looking for earlier, that quality. What is the quality of the company? And I think you'd argue that the quality is probably a bit lower, right? Given the Gen AI, right? That search business, which was, as I said, amazing, probably a bit more challenged in the future. So the quality has been impacted. Intrinsic value is important. That still, looks pretty reasonable, but it goes hand in hand with quality. You'd probably want to pay a bit less given that uncertainty, and risk. So those are the three factors. The risk that the company is facing, that's a little bit elevated. So it doesn't look expensive, certainly given some of those high quality businesses that I talked about, the offsets. But the risk has gone up. The quality's probably come down a bit. And so that speaks to a more modest position size for now. And that will evolve over time. It always does, depending on new information that comes to light. If they can successfully transition, the bulk of the world, or at least a large percentage of it, onto their text generative search products, and can monetize those effectively, then it's a screaming buy, right? And that's a possibility. But if they're at a much lower market share and it doesn't monetize as well, then it could be a less successful investment. So some of this is just going to take time. And some is, what is priced into the stock? So, if we can get that search business at a very low price because people are expecting it to be a basket case, and where they're thinking, well, we've got Google Cloud, we've got YouTube, we've got Waymo, like that's fine, like it's already covered. Then again, it could be a position size.
And what are some of those lead indicators that you might be looking at for search to say, hey guys, our thesis here is on the right track?
You're looking at things like market share of search. You're looking at use. I mean, the use of generative AI tools for search, and how that's being customized as people going as their first visit to access the internet through an open AI. Now, we know they've got 700 million users or something, so they're fairly substantial, whether it's them or some of the other players. Is that where people are going to access the internet, and is that starting to impact impression growth? The number of clicks that basically goes through Google's ecosystem. We saw that being impacted. There is some litigation there going on at the moment as well in terms of their dominance in search, which the market looks to be taken care of, to be honest, but they're still facing some litigation from competition authorities, which it seems a bit backward looking, but that could have an impact in the near term as well, something else we're considering. But yeah, it's about the usage of those alternative search things, the number of clicks that are going through Google, the advertising spend that's going through there hasn't been impacted yet, right? In terms of the advertising growth is still really good on Google. So we'll be watching all those closely.
Excellent. Let's move on to curiosity number 2. What else have you got for us?
Yeah, I didn't want to talk. I mean, Gen AI is fascinating, right, for a lot of companies, but a lot's been talked about it. So I wanted to go back to something a little bit different, which is exercising my mind. And exercise is a key word. It's kind of the sportswear companies. Nike and Adidas is something I'm looking at now. Now they're not in the portfolio at the moment. They might not be. I'm just, something that's quite interesting at the moment, given these companies, we think of really high quality. I mean, you think about Nike in particular and the strength of their historic kind of brand, and it's not a brand built on, just short-term kind of, short-term heat. Yeah, it's endured for a long, long time. And, think about Air Jordan, they own as well. The Nike brand, it's been around for many, many years and is dominated by these big sports sponsorships, which keep it relevant. And no smaller companies just are going to struggle to have that same kind of brand relevance that, a Nike does throughout their portfolio. So it's a really interesting one because they've fallen on hard times the last few years, and really fascinating to go through how such a strong and dominant company kind of went wayward. But is this an opportunity then, as they start to get their act together? They're not going anywhere. They'll still be the world's largest kind of footwear and company, athletic wear company going forward. So, is this an interesting opportunity? What went wrong? Adidas, they're like the global number 2, dominate football kind of, whereas Nike dominate kind of US sports, in particular basketball. And, is this an opportunity effectively? So the Nike one's interesting. They did a direct-to-consumer strategy. They annoyed their wholesale partners. They pulled product from their wholesale partners. And that opened up these other sports stores to carry non-Nike goods. So Hoka and On Running, it's really Nike's fault that these companies all got a really good run at the market, including Adidas. And now they're gearing up to fight back. They've got, they let their innovation kind of slide. They didn't have new good products. Technically, they weren't as strong in performance running, but they can fix that. They've got the R&D. They do have the brand. So that's really interesting how they went wrong and how durable is it, and when do they come back, and what's the opportunity for Adidas in the meantime, and so on. So just very different, but fascinating in its own way.
And how did that come across your table and you sat there and went, geez, I think this is pretty interesting? Was it the falling on hard times and you maybe looked at the share price and went, geez, I didn't expect Nike to be doing that poorly? Or was it the maybe seeing a potential inflection point with the new CEO coming in and from my understanding of it, what you said was quite right. They decided to take their brand, their shoes, out of those chain stores like Foot Locker and whatnot, and do distribution themselves direct through Nike stores, annoying those third parties, those distributors in the meantime, and then and whilst they were facing, whilst new competitors were coming to the market like Under Armour and whatnot. So what was it that piqued your curiosity, and what are you looking for there to turn it from an idea into a Magellan stock?
So, I mean, these are high-quality companies. We've actually covered them for years, right? And we've never had the opportunity to buy them because of that second part, the intrinsic value side. They were well recognized by the market as being high-quality companies, and there didn't seem to be an opportunity there to deliver excess returns. And so, of course, we know them quite well, but then they fell upon hard times. In particular, well, Adidas first, they had the Yeezy kind of collaboration with Kanye, which did not end well. So, they've each had their issues. And then Nike, of course, a big slowdown in China. We haven't even mentioned the China business, which is an important driver. So, some real issues and some self-inflicted issues as well. And, I did mention at the top, I'm a little bit of a contrarian. I think not blindly. I think that's a recipe for disaster. But I think when you are looking at these very, very high quality companies that do tend to come back, they've got that economic moat. They've got sound balance sheets. And that means that, yes, they fall on hard times. All companies are going to have missteps from time to time or negative external factors, but they overcome them and they come back. And that can be the opportunity if you're looking at those companies at those times, because the market reacts to those short-term impacts. The market is short-term in its view. Your sales are down year on year. Your margins are going to be impacted. Sell. Whereas we're like, well, they'll be back in 3 years. So, let's have a look through that and see, is there an opportunity here? Is this a short-term impact or is it more structural? And China's a bit more structural, right? That's not going to grow how it was historically. So we have to balance out the short-term versus the long-term, just make a really rational decision about, well, what is the quality of the company? What is the intrinsic value support here? And is there an opportunity?
And then I guess as well, something to consider would be the health of the wallets of the US consumer at the moment. Is that something you guys are keeping an eye on?
Yeah, absolutely. For consumer companies, we've got a lot of mixed feedback, I would say, from our companies reporting this reporting season. Particularly the lower end consumer is under a bit of pressure. Tariffs of these footwear is manufactured in Asia. They're all facing that impact, but that could be another headwind for consumers in the short term. We don't think this is a long-term impact, i.e. they will be able to work through this, but certainly at the margin would want to consider, what happens if the US consumer struggles a bit more, and take that into account, when we're thinking about potentially entering the stock or position sizing. Fantastic.
Okay, so have we got one more curiosity from you?
Look, I've got another one. I don't want to take your whole day, but I'll just really briefly talk about Universal Music Group, because another one that looks quite different, right?
Okay,
this is
it's essentially a toll road, isn't it? For music.
Yeah, effectively. No, you've got it right. And I think it's a little bit harder to understand than maybe a Spotify. Everybody kind of gets a Spotify. They see their account. They're happy to pay for it. It's pretty good value, right? For all the music you want to stream. I remember my brother had a CD collection of about, 10,000 CDs, something like that. He
10,000.
loved collecting. I might be exaggerating. It was a lot, right? Like the whole walls, were covered in CDs. And I just, walked up with a Spotify and I just thought, I've got them all. I've got all the songs, So it was...
I often think about my son who's 3 years old, and I think about him with YouTube, Netflix, Disney Plus. I think about him with Spotify. Any song, they listen to songs at daycare, and I'll come and he'll try and explain it to me, and I'll be just going through Spotify asking him if it's this, and I'll keep playing a little bit. He'll never know what it's like to have to go to Sanity or Brash's and thumb through CDs.
Yeah, and you managed to get a CD, which you listened cover to cover like 50 times, right?
Yeah.
So it's a very different world. But a lot of people will get that. And that's a nice business model, right? Because they'll get it. You pay a subscription. The number of people paying around the world are going up. And the price that you'll pay over time will go up as well, of course. It hasn't really, but there's some latent pricing power there. So, we don't mind the top line revenue outlook for a Spotify, for example. It's a little bit too expensive for us at the moment, but very easy to understand. But what's harder to understand is, I guess, behind them stand these music labels like Warner, Sony, and the biggest by far, Universal Music Group. And they represent the artists and make sure they get paid, no matter where their music is monetized, whether it be a Spotify or an Apple Music. These subscription services are the big part, but also in movies and live and radio and wherever else their music is played. So, and they're in a really strong bargaining power with Spotify. They're really more partners than competitors. They want to work to grow this music pie. And because Spotify does not work if they don't have Universal Music Group's artists. This is, they typically have between 5 and 8 of the top selling artists each year are Universal artists. And, we're talking, the prime artists of the day, typically. So they must have them, and that means that as Spotify grows, Universal will get paid, and they'll make sure their artists get paid. So no matter how the music is monetized around the world, and we think it will continue to be monetized strongly by these subscription services over time, that's a real tailwind for the likes of Universal. We're a really strong competitive moat position to make sure they get their cut and their artists get their cut.
Yeah. So what are the risks to Universal Music? Because you can't see streaming going away. But
No.
what are the risks to that type of business model?
Well, I mean, people would have argued that the streamers will get more power and be able to pay less. I think it's really balanced, as I said. So I don't consider that a major risk. Of course, they do have to keep the artists happy. So they will be paying out a portion of a big portion of that revenue they take into artists. So any change in the negotiating power with artists, artists can go independent, avoiding the major music labels. People have thought this might be more doable in a modern world, right, where you can just go online and put your music in SoundCloud, and maybe you don't need a label. But you think about how complex the global music industry is with streaming, with movies, with old school radio. CDs are still a thing in Japan. And to be a major artist around the world, you kind of need the backing of a label or a label service, which Universal also operate, very many different brands. Some are more self-service, some are full service. So they do cover a range. But that would be the risks, that they can get cut out. Artists can go directly and put their music on Spotify and write something like that. But I think it's a very manageable risk for this company. They still play a really important role.
That's great. Well, Alan, I really appreciate that. So we've had Alphabet at the top, which is currently a portfolio position, but in a reduced weight to what it was.
Yes.
We then had Nike and Adidas, not portfolio positions, but thoroughly on the Magellan watch list. And is Universal Music Group in the portfolio currently?
That one's in global opportunities at the moment. Yep.
Excellent. So now I've just got a couple of short reflections for you, Alan, just before we let you go. We do these with pretty much every guest that we get on the podcast. I want to know, what was your worst investment and what did you learn from it?
All right. Well, there's probably a few to choose from, particularly in my early days where, you wanted to get stuck in, but you didn't really know what you were doing back at university or whatever. But I'd say the one that really taught me the biggest lesson is just leverage. It's not actually a stock. It's leverage. So, I was young in my early 20s. I didn't have a lot of money to invest at the time. And I thought, well, I'll get a margin loan. So I've got a little bit more money to invest, right? And, we went to 2000. And of course, portfolios around the world got hit. Mine no more than worse, but, it was hard to find many stocks going up during that period. And, a 30% down year turned into a 60%. And you're kind of starting again, right? Like once you use that kind of capital. So you've just got to be
margin called.
I never got margin called, but it was, just leverage is dangerous. And it taught me that both in a company, most of our companies are really great companies, really clean balance sheets, but not all are around there. And personally, if you are leveraged, it just magnifies, it helps with those gains, but magnifies those losses. And I think at the moment, with markets being so solid the past few years, that people can get
get complacent.
Complacent. Yeah. Forget that markets can go down. They can go down suddenly. They can go down significant amounts. And if you ever have to be forced to sell at the bottom, that is by far the worst outcome you can have as an investor. So I would never, ever want to be in the position where I'm forced to sell, a forced seller, because that's often the time that you actually want to be a buyer, right? So never put yourself in that position. Always make sure you've got some downside protection in place so you can actually be a buyer at those moments. That's when you get the best opportunities. There's it felt bad at the time, but that was actually a pretty valuable lesson.
And learning that lesson young is a good thing because you probably didn't have hundreds of thousands behind you to learn that lesson. It was a small amount of money, and so the impact is relatively negligible to where we are.
It felt like a lot at the time, I'll tell you that. But, luckily I was young enough to rebuild it all back up and more. But, if that happens where you don't have that time to actually rebuild, that's a disaster.
Right. So if you had to recommend one book, an investor or a company or all three for someone listening to this to dive into, what would it be?
I think the easy answer would be Warren Buffett. So I'm not going to say that. So I'm going to give you something different. And I'm going to give you something I think is really interesting and pretty easily accessible for people. It's not a big, dense investment book. It's Howard Marks's memos. So Howard Marks is, not really a stock investor, distressed debt, but really well regarded in the investment community. And his memos are really digestible. And you can go back and they're not too long. They've really got good insights in how to think about markets, how to think about risk, how to think about equities. And whenever I read them, I'm just like, this guy's thinking in a very similar way to kind of how I'm thinking about stocks and risks and how the markets work. So I think very digestible, not too dense or thick. They're available on Oaktree. He's obviously founder of Oaktree. So you can go there and find his memos. I think they go all the way back, so free as well.
Yeah, and you can pick up a copy of The Most Important Thing, which is a really popular book by Howard. And he's actually done he's had a little bit of experience in Australia. Well, Oaktree has anyway, because I remember their name coming up in the whole Blue Sky asset management saga, if you recall that. So, an interesting little chapter where Oaktree were active here in Australia. Right, so 2 last questions. Now, Owen always asks this one of guests coming on. And what is the one piece of advice, be it about investing, finance, or life, that you would give to your younger self?
Don't use leverage.
Don't use leverage. I was reading that. I thought, geez, we've already had one of these lessons.
No. Well, I'll go another one. Do start early. You will make mistakes, but those mistakes will be manageable because you start early. And I'm sure many people have talked about the wonders of compounding. They are real. They are very, very real. And they're much, much greater impact if you start early. So, I have my kids, they've got bank accounts with the Bank of Dad where I give them a high interest rate, try and encourage them to get saving. They have to put some of their birthday money, Christmas money, they have to put a little bit in these kind of Bank of Dad bank accounts to make sure that starts early, that compounding.
Do you invest for them?
No, I give them advice. Now they're, thinking about the market and so on. So, encouraging, as I said, to start early and to get in. Yes.
It's interesting because I was talking to some of our investors and I wrote something on it this morning, just a bit about how to encourage teenagers to start investing or start thinking about investing. What would you say there? Like, of course, helping them out with the actual financial means to do it is a good start. But what would you do to pique their curiosity?
Yeah, it's tough because, it can be a dry subject. I more talk about it in terms of, do you want to build wealth over time? Do you want to be in a position where, you have options in life? Or do you want to be solely reliant on your wage and have that for your whole life? Or do you want to, have the financial freedom, the flexibility to have a second income effectively from your shares, your equities, or your other investments working for you? And, that becomes pretty interesting to them, as they start to realize, as they're teenagers that they need money, they're spending money, right? And it'd be nice to have that second effective income coming through. So I found it was more that, what kind of lifestyle do you want down the track? Because now's the time to start thinking about it.
So that aspirational angle. Yeah. Oh, yeah, fantastic. And finally, this is a question that I always ask. You're based in Sydney, Alan. So I'm presuming it might be in Sydney. It doesn't have to be. It can be anywhere. But me and you are going for a long lunch. We've got our out of office on. We're not coming back to the office. Where are we going and what are we having?
Well, if we don't have to be in Sydney, I might take us down to Tassie.
You're a global investor.
Well, I grew up in Tassie, and it is a beautiful place these days. Lots of great food and wine venues. I love the wineries. The wineries are nice. And Hobart, they're very close to town, so you can head out. There's a place called Frogmore Creek, which is in the Coal River Valley. Beautiful spot overlooking the lush Tasmanian kind of landscape. Great food, amazing desserts, and of course some of the wine. And Tassie, it'll be a Pinot. So, that's what we'll be doing.
Frogmore Creek. I think I have been there. So if you ever have a delayed flight coming during the day, coming out of Hobart, that wine region is literally 20 minutes from the airport.
So absolutely. It's on the way from the city, so it's very convenient.
Yeah, excellent. Alan, this has been great to have a chat with you today. I really appreciate your time and appreciate you sharing all this these insights with our audience. Thank you very much.
Oh, thank you, Mitchell. No problem. Anytime.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.